In around 2012, George Osborne brought in a number of changes to the taxation of, in that time, generally non-UK property investors. These measures were very successful in raising revenue for the Treasury, and it's my view that this is where the government had the realisation that taxing bricks and mortar was an incredibly effective way of generating tax revenues, and as such the government has embarked on a fairly sustained attack on buy-to-let property landlords in particular, increasing tax rates, reducing reliefs for landlords and generally plundering as much tax as possible. It's therefore important that the landlords keep on top of the structure of their portfolios from a tax perspective and also take advice when they are acquiring new properties. So in terms of stamp duty land tax, there have been various reforms starting in 2012. However, probably the most painful has arguably been the introduction of the 3% rate for the acquisition of so-called additional properties in April 2016. This is fairly and squarely aimed at buy-to-let investors and those with purchasing holiday homes, and it is a significant additional transaction costs. And speaking of painful changes, the rules surrounding the restriction on interest relief are now in their second year. This is often referred to as Clause 24 by property investors, and the effect of the rule is essentially to disallow the deduction of finance costs, including interest, from the tax computation. Of course, doing this creates phantom taxable profits and will dramatically change the economics for portfolios which are highly geared. The changes are being phased in, and as I say, we're now in the second year of that phased introduction. The rules only apply to residential property investors for now, so commercial property investors don't have this concern. In addition, corporate entities are also exempt from these restrictions. Finally, and recently, the headline rates for capital gains tax were reduced to 10% and 20% respectively for basic and high rate taxpayers. However, these savings have been denied to residential property investors who remain subject to tax at 18 and 28%. It's difficult to see why a buy-to-let landlord should pay a higher rate of tax on gains than someone who hangs a painting on the wall. The only explanation really being that it's a case of the government plundering more tax from bricks and mortar. It should be said that there are a number of structuring opportunities for property investors. Perhaps now more than ever, significant benefits can be derived from the correct structure. Over recent weeks, months and years, we've advised incorporation of property portfolios, we've advised on forming hybrid partnerships and also use of various types of international pension schemes to hold properties, to name but three. However, despite some property commentators in the market suggesting otherwise, there is no silver bullet, no one-size-fits-all solution. As with all tax planning, the key is that each property investor will have their own individual circumstances and their own objectives. And it's important that any tax planning puts those first and foremost. So if you have any queries about your tax position as a landlord, please do get in touch with us.